Most people think investing is complicated or risky. In reality, investing is simple. It just never has been explained clearly. My name is Jack, and this channel is about the fundamentals of money, fitness, and life systems. In this video, I'm going to go over how investing actually works and hopefully explain it in simple terms so that you can understand what you're really doing when you invest and what it is. So, let's go ahead and get into it. So, what is investing? At its core, investing is ownership. Right here with the big green check, ownership. When you invest, you're buying a small piece of a real business or an asset that produces real value. So, like I said, with assets, you could have things like silver, gold, real estate, a piece of a business, a car, collectibles, really anything that people ascribe value to. So, you're not guessing, you're not gambling, you are owning, specifically ownership. And the idea of investing is that you take extra money that you have and you buy assets with that money with the intent that they're going to be worth more in the future than they are now, or give you some kind of yield or benefit financially. So, moving on here, kind of touched on it a little bit, but what investing is not. So, it's not gambling, it's not guessing, it's not day trading, it's not checking prices every day, and it's not a get rich quick scheme. So let's get into these a little bit here. So with like gambling, that's more of like an entertainment mindset. Of course, it's cool to win money when you're gambling, but it's not really like with the intent of building wealth. With the guessing aspect, the idea when you invest is to actually do like research or have some kind of informed position on what you're putting money into. Like you wouldn't buy a house and just hope or guess that it's going to go up in value. You would actually do research into the area, the other home prices around that house, the structure of the house. You would get an inspection. You would look into the cost of the house, what kind of repairs you're going to have to do. And these are all kinds of things that you can apply to any kind of asset that you're investing in. Day trading. So a lot of people would do day trading, and it seems like investing because you use similar platforms to investing, but it kind of falls more into like a guessing and gambling type scheme. And people do make money, but the reality is that a very low percentage of traders actually make money day trading. In this lesson, I'm sort of pushing for more of a long term growth, wealth building mindset. So, checking prices every day. This is sort of just a bad mentality to have. It can lead to a lot of stress and anxiety too. Because the reality is you're going to buy an asset or make an investment, and the price is going to go down for a week, and then it might go up for a week, and then it might just go sideways for a month. But over time, that asset will hopefully increase if you invested correctly. Same with a house. You don't check your house price every single day. You would check your house price maybe once a year or maybe like once every 5 years. So the last part, like I said, this is not a get rich quick mindset. We're trying to build wealth over a long period of time. So I just wanted to touch on this again real quick. It's the idea that you own a small piece of a whole. So you could own an entire business, or you could own a whole house, or you could own a large portion of a stock. But for now, since this is a beginner level fundamentals course, we're just getting into like buying small pieces of things and how over time you can grow that into something bigger. All right. So why do markets grow over time? So if you invest in a stock or into the stock market, the idea is that it's going to go up over time. And as we've seen, just for an example, the US stock market has continued to grow throughout the years. And the reasons it continues to grow is because of innovation. Companies are always creating new products, they have new marketing, and that leads to their increased productivity. they're selling more products, they employ more people, and they're moving more money around. And so when one company increases productivity, and then hopefully a bunch of companies increase their productivity, the entire economy grows. More people get hired, more product, the GDP of the country goes up because there's more product being sold, made, produced, and moved around. So this brings me to that key part of ownership. When a business grows and earns profits and they reinvest those profits back into the business, the owners of that business benefit. They actually get to take some of those profits. So that's where like these long-term results come in. And if you own a piece of a company or a lot of companies and those businesses grow and earn profits, you then become one of the people who benefits from that growth. All right. So there will always be short-term ups and downs, and that's totally normal. Like a company should never grow in one straight line up over time. In reality, markets don't really work like that. If you see a huge growth in a company or a market, it's natural for there to be a small pullback. And that's just the way that, because like money has to flow around, and like a small step back can lead to another huge step forward. All right, so now we're going to get into risk. So I'm sure you've been told at some point that investing is risky, and it can be, but our job is to minimize risk. So risk in investing doesn't mean that you lose everything. It just means volatility. Like we talked about, that prices move up and down. And your job as an investor is to deal with that volatility mentally. And one of the ways that we reduce risk and not worry about volatility is we use time. Time reduces risk. So the longer your time horizon, the less these little day-by-day movements actually matter to you. If you invest with the mindset that you're going to hold on to this thing for 10 years, why do you care if the price went down $5 today, when in 10 years from now it'll be up $1,000, is the overall idea. The longer you're in something, the more the risk is reduced. So like the biggest advantage most people have in investing isn't how smart you are. It's just how patient you are, or how much time you're willing to put into something. Starting early, here in red for a reason, starting early matters more than starting perfectly. You don't have to be perfect. Okay, so what are some common mistakes with investing? One, people wait too long to start. The earlier you start investing, the better off you are in the long run. There's a saying, when is the best time to plant a tree? And the answer was yesterday. But the next best answer is today. If you want to see that tree grow and become a bigger tree, hopefully bearing fruit, then you want to have it have as much time as possible to grow. That's just a simple way of putting it. Number two here, overcomplicating. So investing really doesn't have to be that complicated. It's relatively simple. Like I said, you're buying a piece of an asset or a piece of a company, and that's about it. Some of the stuff like actually going into a brokerage account or going to buy something, maybe there could be some difficulty there. Hopefully I'll explain some of that in another video, like how to actually set up a brokerage account, how to actually buy stocks or invest, but that'll be for another video. This is just the basics. And our last mistake here that a lot of people make is trying to predict the market. So it might be like you heard that oil prices are going to go through the floor, and so you sell a bunch of oil. That's you trying to predict the market. Whereas you might say, well, I think over time, oil prices are probably going to go up. So why even try to predict it? Just stay in the market, have the time in the market to reduce the risk and benefit from the overall value increase. Another thing here is A common mistake is people take advice on specific stocks from people who may or may not actually know what they're talking about. Like, you might have a friend come to you and be like, "Oh, Amazon stock is going to go up in the next month because they just hired a bunch of new people." And then maybe you see that stock tank. Maybe it goes up, but over time, like sometimes taking tips from people that are very specific like that can lead to negative profits. So you don't need to predict the future to benefit from it. I'm going to say that one more time. You don't need to predict the future to benefit from it. You really just need to focus on time in the market. The longer you invest for and the more you invest for, the more likely you are to be better off in the future. Like I said before, starting matters more than perfection. You don't have to be perfect. And here in red, you can take one thing from this. If you start investing, you do not need to predict the future to benefit from it. All right, so what's your action step here? What should you do next to actually take advantage of this information and to benefit from investing? So, first here, I don't want you to go buy anything. Don't go buy a bunch of stocks or anything. Take the time to research and understand that investing is ownership and really try and like learn the most you can. I know I said like time is imperative, like you want to get in and be in the market longer, but you want this to be a well thought out and planned step of investing because it's one of like the most important things that you could do right now. And the overall message of this whole video is long-term thinking is the goal. Don't think about trying to get rich now or how are you going to put $10,000 in your bank account by the end of the month. Think about, do I want to be financially free and be set up in the next 10 to 30 years? That's a lot more manageable and like doable mindset to work with. So do those things. Don't buy anything, research and learn, and then understand that investing is ownership. And then go from there and start to implement investing into your finances. All right, my next video right there is going to be on stocks versus ETFs versus mutual funds. I'm going to go over the differences between those and how they can benefit you in your finances. If this helped you, please consider subscribing. And like I said in that next video, ETFs, stocks, mutual funds, we'll go over that and why it actually matters. Thank you for watching, and I appreciate your time.